Millions of people are throwing away more wealth by investing in the wrong order than they will ever lose in a bad market. Let me show you why. First, 1 in 3 Americans have no emergency fund. $500 is the typical backup. And yet the most common money question I get is which crypto or stock to buy next, sometimes while they are drowning in 22% credit card debt. If you are living paycheck to paycheck, or you are not sure whether to invest or pay off debt first, you could be silently losing 6 figures over your lifetime. Today, I am showing you the exact step-by-step order that lets you maximize returns, stop unnecessary losses, and build real wealth. No more leaks in your financial bucket. I will break down every myth with real numbers and examples so you come out ahead. Stick with me because even the most financially savvy people get this sequence wrong, and the results will surprise you. Picture this. You are faithfully investing in the stock market every month, proud of your growing portfolio, while that little patch of credit card debt in the background balloons quietly at 22% interest and wipes out your gains faster than you can blink. For years, I have watched people approach wealth building like a buffet line, sampling a bit of everything, but piling their financial plate in the wrong order. My name is Jim, and here on Jim Invests, our mission is to take the drama and guesswork out of your money moves so you can actually build a life you want, step by step. Now, let us start with a cold reality check. According to recent data, 1 in 3 Americans does not just lack a robust emergency fund, they do not have one at all. For those who do, the median savings is $500. Stop and let that sink in. $500. That is lower than many car payments in America. Less than some folks spend on streaming and takeout in a single month. Even worse, that number dropped from $600 just a year ago. At the same time, these same Americans are stressed over which hot stock or trendy crypto to buy. Seriously, should you be picking out a dream car when your current ride cannot make it to work? Sequence matters more than selection. Building wealth is not about chasing the sexiest investment. It is about plugging the leaks before pouring water into the bucket. If you are skipping steps, the opportunity cost over a lifetime is staggering. Every month you drag your feet on high-interest debt, like a 22% annual credit card, is a month you are compounding losses instead of earnings. For every employer match you leave untouched, that is literally free money slipping through your fingers and putting after-tax money into a regular brokerage account before you have maxed out. Tax-advantaged accounts, you are basically sending the IRS a tip they never asked for. I know what you are thinking, but Jim, all this basic stuff is boring. I want investing tricks, not pep talks about safety nets. I get it. But let us do something most people do not. Start with the right foundation. Today, I will walk you through what I call the proven wealth sequence. Each step in exact order, with every number, every pitfall, and every tactic. I promise the employer match situation and the hidden power of HSAs will surprise you. Before we dive in, quick disclaimer. This content is educational only and not individualized financial advice. Your situation might vary, so always consult a qualified financial advisor before making major decisions, especially about investments, taxes, or debt payoff. Let us anchor this with a house analogy. Nobody picks tile patterns or lavish lighting while water pours through a broken roof. So why put money in the latest ETF if your financial ceiling is still caving in? Let us patch the leaks first. Step 1. Build your emergency fund first. Your absolute priority is to create an emergency fund. This is not negotiable, and it is not just about dull what-if scenarios. An emergency fund is your psychological body armor, preventing you from catastrophically derailing your progress when life hits you with a $1,200 medical bill or your transmission gives up. With even a few $100s tucked safely away, the odds that you will panic sell investments or get sucked into new debt plummet. So, how much is enough? The common advice is 3 to 6 months of expenses. But that range is so vague, it is almost paralyzing. If you are a public school teacher with stellar job security, maybe 3 months is enough. But if you run your own business or depend on gig work, aim for 6 months or more. Here is my approach. First, sprint to your first $1,000 emergency buffer. No excuses, no delays. Sell stuff, cut expenses, do side gigs. Hit that number fast. Once you hit $1,000, build to a full month of living costs. Rent, food, bills, no luxuries. After that, set your sights on 3 months' worth, adjusting upward if your situation is unstable. Why does this matter so much? Research from Vanguard found that people with at least $2,000 in emergency savings have financial well-being scores 21% higher than those who have none. That is the largest boost from any factor they measured. Not income, not investments, not credit scores. Just the psychological buffer makes a major difference. Let us mark off step 1. Emergency fund established, leaks plugged. If you are already here, let me know in the comments below. Just drop an E1 so I know you have hit this fundamental. Milestone. Step 2. Crush high-interest debt. Next priority. Destroy any debt with an annual interest rate above about 8%, especially credit cards, which average over 22% annual percentage rate. But also things like payday loans. Carrying these debts while investing elsewhere is like climbing a mountain while towing a trailer. It is mathematically almost impossible to come out ahead. Some folks will ask, but what if I am making 10% on my investments? Here is the cold math. If you have $5,000 in credit card debt at 22% interest and pay only the minimum, you will fork over almost $2,800 in interest over 5 years. That is money evaporating from your future, never to return. Crunch the numbers. Every $1 you pay off at 22% interest is saving you more than Warren Buffett's long-term market average. Do not toss money into unpredictable markets when lopping off debt gives you a guaranteed return. Here is the method. First, write down every debt, their interest rates, and minimum payments. Second, pay the minimum on everything. Then pour all extra money into the highest interest account. That is the avalanche method, proven to work fastest, saving you the most overall. Some need a motivational jumpstart, so paying off the smallest balance first. The snowball method is fine, as long as you switch to avalanche for maximum efficiency. Pause here. Comment below. Are you still paying down debt, or have you wiped it clean? Hearing where people are at keeps us all motivated, but there's a twist in this sequence. One massive, mathematically justified exception. Step 3. Snag your employer's free money. Employer match. If your company offers matching contributions to your retirement plan, like a 401k, you need to grab every penny of that match, even if you still have high-interest debt left. I know, sounds crazy, but matching is a 100% or 50% or even more return on day one. Nothing else on earth offers that. Let us break down what this can look like. Suppose your employer matches 50 cents per $1 up to 6% of your $50,000 salary. That means if you contribute $3,000, they will throw in $1,500 for free, a 50% instant return, plus any market growth. Review the numbers. If you skip this, you are refusing $1,500 in free money per year. Even with a 22% credit card, this still almost always pencils out. Here is the sequence. First, put in just enough each paycheck to hit the full company match. No more at this stage. Second, redirect anything extra to killing off that nasty high-interest debt. Quick heads up. Some companies make you work there for a certain number of years. A vesting schedule before the match is 100% yours. Look that up so you are not counting chickens before they hatch. But even with a vesting requirement, taking the match is usually worth it. Let us check in. Drop a match in the comments if you have landed employer matching funds. If you have not, go double-check your plan today. That is free money on the table right now. Emergency fund, check. High-interest debt, gone. Employer matching, secured. This is the bedrock of smart investing. Without these steps, everything else is built on shaky ground. Step 4. Open and max out an IRA, individual retirement account. Now you are in the tax optimization zone. Most folks make a huge mistake here, jumping straight to their 401k or even taxable accounts. But there is a reason IRA comes before 401k after the match. You get more choice. Almost any index fund, exchange-traded fund, or mutual fund. Not just your company's limited menu. Fees are usually way lower. Many 401k plans charge 1 to 2%. While you can snag total market index funds in an IRA for less than 0.1%. That may sound tiny, but over 30 years, an extra 1% fee could cost you tens of thousands. 2025 numbers. You can put away up to $7,000 in an IRA. $8,000 if you are 50 or older. Big decision. Traditional or Roth? Traditional IRA lets you deduct today, pay taxes in retirement. Roth IRA, you pay taxes up front, but withdrawals in retirement are 100% tax-free. Which to choose? General rule, lower tax bracket now, go Roth. Higher bracket now and expecting a drop in retirement, go traditional. But honestly, splitting your contributions can help future-proof your taxes. Nobody knows tax law. 30 years out. Remember, anytime we talk about investments, I have got to drop this disclaimer again. This is educational only, not financial advice. Past performance does not guarantee future results. Consult a licensed financial advisor for your specific situation. Step 5. Max out your HSA, Health Savings Account. If eligible, this is where the magic happens. SAs are the Swiss Army knife of accounts, and most people have no idea just how powerful they can be. Every dollar you put in is tax deductible, just like a traditional IRA. It grows tax-free while invested, just like a Roth. And you can withdraw for qualified medical expenses tax-free today or 30 years from now. 2025 HSA contribution limits, $4,300 if you have individual coverage, $8,550 for families. The catch: you need a high deductible health plan. But if you are young, healthy, or have manageable medical costs, This is often a fantastic deal. Real talk, the secret HSA strategy is to pay out of pocket for current expenses. Save your receipts and let the HSA grow in the market. Years or decades down the road, you can reimburse yourself for those old expenses, tax-free. No expiration. Let us see the numbers in action. If you max out your HSA every year for 30 years and earn a 7% yearly return, you could have more than $400,000 tax-free for health costs. Considering that the average retired couple is projected to spend over $300,000 on health care, having this pot of tax-free cash is basically bulletproofing your retirement after 65. You can use HSA money for anything you like. You will pay regular income tax on non-medical withdrawals, but for medical costs, it remains tax-free. Think of it as a bonus IRA, but better for certain expenses. Have an HSA and use this strategy. Share in the comments below any wins or questions. If this part is confusing, just write HSA, help. I will reply there and may even make a full video on it. Step 6. Go back and supercharge your 401k. Once your IRA and HSA are maxed out, revisit your 401k or 403b and crank up contributions beyond the match. For 2025, you can sock away $23,500 if you are under 50, or up to $31,000 with catch-up contributions if you are over 50. That is a serious tax shield, money you are letting quietly compound every year without Uncle Sam grabbing a slice. Combine your annual caps, IRA, HSA, 401k, and you could be sheltering $35,000 or more a year from taxes if you are under 50, even more with catch-ups. That is not a typo. Most people never get here. The average American manages just a 6% savings rate, barely enough for the company match and maybe an IRA. If you clear all 6 steps, you are already part of the top 5% of savers. Let us take a pause, screenshot, or jot down these 6 steps. The Wealth Order Checklist. If you want a printable version, I have made one for you. The link is in the description, and it is 100% free. Curious how much tax efficiency matters? Imagine investing $10,000 per year for 30 years at a 7% average return. In a tax-advantaged account, you could end up with $944,000. In a taxable brokerage, after factoring taxes paid every year, you might be left with just $700,000. That is a $244,000 difference, all from the order in, which you invest. Final step, taxable investment accounts. Now, and only now, are you ready to open the floodgates to taxable accounts for optional investing, diversifying, or shorter-term goals? This is the Wild West. Invest in stocks, exchange-traded funds, options, even crypto or alternative assets. Just remember, every dividend and gain is taxable, and frequent trades can really eat into profits. Taxable accounts have flexibility, though. Need cash for a house in 5 years? A well-chosen taxable account gives you fewer restrictions. Want to retire before hitting 59 and a half? Taxable money bridges the gap before you can touch retirement funds, penalty-free. Planning to leave wealth to family? Taxable accounts get a step up in basis when you pass away, which can wipe out capital gains taxes for your heirs. Let us run the TLDW summary. Here is the proven wealth sequence in 1 minute. First, build your emergency fund. $1,000, 1 month, climb to 3 or more months. Second, crush all high-interest debt, 8% or higher. Credit cards first. Third, grab every employer match. Free money never comes again. Fourth, max out your IRA, traditional or Roth, your choice. Fifth, max out your HSA if eligible, best if you are healthy or young. Sixth, back to your 401k or 403. Beyond the match, all open or expand taxable investment accounts, stocks, exchange-traded funds, everything else. Get these in order, and you are tracking for genuine stress-free wealth. Sequence trumps selection. Do not build on debt, plug the leaks, bag the freebies, and use every tax break that fits your situation. Skip the steps and you will waste more money than any bear market could possibly take from your future. Which step are you on right now? Drop it in the comments. Your answer could help someone else on the same journey. And if you have checked every box, drop a rocket so we can celebrate your discipline. If this sequence clarified your next money moves, hit like and share with a friend who is stressed about investing. And do not forget, download my free wealth order checklist via the link in the description. Keep it handy, refer to it often, and keep stacking those wins. Remember, none of this is individual financial advice. This is educational content. Your numbers, risk tolerance, and timeline will be unique. Past performance does not guarantee future results. Connect with a qualified advisor before making big changes. And subscribe here on Jim Invests. Up next, I will break down the exact index funds I use with real numbers on risk, return, and how to build your own diversified portfolio step by step. Let us do a lightning-fast recap. Building wealth is about putting things first. Plug your leaks with an emergency fund. Destroy high-interest debt. Grab your employer's free match. Max out your IRA and HSA if eligible. Ramp up your 401k. Then, and only then, unleash in taxable investing. It all comes down to order, not just selection. Your immediate action. If you have not started your emergency fund, set up a new account right now and automate your first deposit. Do not even think about other steps until this is in place. If you are midstream in debt payoff, update your list of balances and refocus all extra cash on those high-interest accounts using the avalanche method. Already on steps 3 through 6? Log into your HR portal. Check your 401k match status. Compare your IRA and HSA options on a fee calculator. And calendar your next contribution dates for maximum momentum. In the next 60 to 90 days, your job is to hit that next milestone, whether that is eliminating the last credit card, maximizing your IRA, or finally opening an HSA. Over 6 to 12 months, track your progress every quarter with the free Wealth Order Checklist. Download it below. This is a marathon, but each step pays compound dividends. When will you feel it? Often within 1 or 2 paychecks. A little more margin, a building sense of control, and soon a growing pool of invested wealth working in your favor. Realistically, seeing big results takes a year or 2. But follow this order, and you are giving yourself the best shot at financial independence. Starting now. If you want to keep leveling up, subscribe to Jim Invests. Next video, I am revealing the real index fund portfolio breakdown I use myself with risk, returns, and proven diversification logic. Turn on notifications so you do not miss it. And do not forget, download the Wealth Order Checklist to print out and review each step as you go. Comment below with your biggest challenge or which step you are working on right now. My team and I answer as many as we can each week and choose top questions for the next deep dive. Final word. This is educational only, not financial advice. Past performance does not guarantee future results. Always consult a licensed financial advisor about your own situation. Start with the right order, and your future self will be grateful you did.